Hi, everyone. My name is Nick Showlambus, and I'm the Managing Director of Alpha Wealth. Thank you for joining the session today, which is about reducing your tax significantly. We've had a lot of interest in tonight's webinar, and there's actually over 100 people who are registered, so it just shows the, I suppose, the popularity. I will get started in less than a minute. Just for those of you that have signed up, I'm just going to give people just a minute or so just to join. In the meantime, I'm just going to put up a poll just to kind of register a little bit of interest about the upcoming budget for next Tuesday. And obviously, we're listening closely as to what we think could happen just in relation to, I suppose, helping us, particularly in the area of tax and helping to reduce that. So please feel free to fill in the answer to the poll just while you're waiting. As I said, I'm going to get started there in less than 30 seconds. Just while we're waiting, for those of you that are not familiar with Alpha Wealth, we're a financial services company, Cork-centric. We have an office in Little Island, but we also have a small presence in Dublin, and we provide independent financial advice to people all over the country. We have 8 advisors who are fully QFA qualified, who are professional, with over 60 years combined experience between us. So I just want to start, and basically, anyone who would like to answer any questions, please feel free to do so in the chat function. My colleague, Clean O'Donoghue, who is our Business Development Director, is also on the call, who's going to be doing some questions at the end. And we have had some questions come in over the last couple of weeks. So what you can see on the screen here is just in relation to, I suppose, setting out a roadmap. And this is really important, particularly if you're trying to grow your wealth and basically look to achieve what I call financial independence. And what we're trying to do in Alpha Wealth is help people to understand about where they are currently and really what direction they're going in. So the starting point really is for this evening, how to reduce your tax. And typically there are 2 main ways in which people can do that. The first of which is through a pension contribution. And I'm going to go into a little bit more detail about this. Some of you may have pensions, some of you may not, but it's really to understand exactly how you can benefit, particularly in the next 4 weeks or so before the tax deadline, in terms of making sure that you do get contributions in before that deadline of the 16th of November. Also, there's another opportunity which some people may not be familiar with about how to get tax back over the next 5 years. And I'm going to go into a little bit of detail to explain that to you as well. So just to understand this and to use an example, if you're in your 30s and if you're earning, say, a salary of about 50,000 euros, you're allowed to put 20% of your salary into a pension fund. And a pension fund really is just a long-term savings plan with great tax benefits. And the benefit of doing it before November, and I would argue before the end of October, is that you would get 40% of a relief for tax that you suffered last year. And you can also do the same for this year. So the example here shows you that you can put in basically 20,000 euros on a salary of 50,000 and get an 8,000 euros immediate tax back, which would mean that your net payment would be 12,000 euros. Now, if you do the maths on that, if you were to get 12,000 euros and turn it into 20,000, that requires a return of 66%, which is huge. If you're in your 40s, you're allowed to put up to 25% of your salary. If you're in your early 50s, up to 55, it's 30%. And then in your late 50s, the contribution rate goes up to 35% of your salary. Now, some of you may be thinking, well, that's not really feasible, or, you know, there's no way in which you can do that. But there may be people that have money sitting in the bank, not earning interest. There may be people who can generate savings from other areas, which I'm going to touch upon later on. But again, it's really important to understand the scope in which you can fund for your retirement in a very tax effective manner. One of the things that when I'm speaking to people, and they generally, I suppose, say that they don't necessarily have the time to kind of look into this, or they don't necessarily have the understanding. And what we offer in Alpha Wealth is an independent review where we can help you hassle-free. The main questions I generally suggest that you should know the answers to, and certainly if not, allow Alpha Wealth to do that on your behalf, is find out the current value of your pension or pensions. Some of you may have pensions, obviously, from previous employment. Also, just checking into what level of contributions you're paying and what opportunities you have in terms of things like additional contributions, whether you're in a state scheme or indeed a private scheme. where your funds are invested, a lot of people are maybe a little bit concerned about the current climate and not sure about exactly where their monies are, whether they're in high, medium, or low risk funds. But finally, and most importantly, the key thing that I would say to all of you is that it's really important to know where you're likely to aim and end up on your current trajectory. And what I mean by that, and I'm going to give a very specific example of myself. I'm 48 years of age, and I have projected my retirement age out to 65. That's the time at which I'd like to think that I'd be financially independent. You can see on the screen here that my current fund of a pension is about 100,000. And in terms of contributions, at the moment, my company is paying 5% of my contribution, and I'm paying 10%. Now, the key number, and there's a lot of information on the screen here, but I want to draw your attention to this magic number of 491,000, which is in the top half of the screen there. And you can see then in today's terms, which is on the right-hand side, what it equates to. So if I continue paying contributions of approximately 15% of my salary between my company and myself, at 65, based on certain assumptions that we check and target on a yearly basis, it looks that will have a fund of about 300,000. Now, in terms of whether that's a strong pension or a weak pension, it's actually the average pension scheme in Ireland. The general pension scheme that most people on average would retire on is 300,000. It is a little bit light. And what I'm suggesting to people this evening is if you want to try and reduce tax that you pay, it really is important to focus on looking at your pension as a contribution. For those of you who did come into this late or maybe listen on playback, as I said, we are going to give an opportunity at the end of this to answer questions. If anyone would like to answer me questions separately, obviously I'm available, and please feel free to contact Alpha Wealth. We're more than happy to answer any questions you may have. Just to dive a little bit deeper into pensions, the best way to reduce your tax, as I said, two ways. Pension schemes are really savings plans on speed. And the reason for saying this is that for every 100 euros you put into your pension scheme, if you're earning over 37,000 a year or more, you will get 40% back, i.e. 40 euros for every contribution. Now, somebody challenged me the other day saying, oh, pensions are just tax deferral, so you pay tax at the end. And the thing about that is that firstly, not only do you get 40% relief, and typically at the other side, you only pay tax at 20%. It's not a lot of people that pay tax at 40% plus on their pension drawdown. The second thing is that your pension fund grows tax-free. So you benefit from all of the years, in my instance, 17 years from now, where you don't pay any tax on the growth of your pension scheme. And then the third thing, importantly, is that you get a quarter of your pension tax-free as well. So there are three reasons why I don't think that argument stacks up. Now, in terms of what I've spoken about, what is a good pension fund, how much should you aim for? I've put down three figures here: 400, 800, and 2.15 million. 400,000, obviously 800,000. Now, the reason for 400,000 is that if you were to get to 400,000 at retirement age, that could be 55 for some, it could be 60, it could be 62. There is no defined date. The state benefit, obviously, as we heard earlier in the week, is set at 66, but they're giving people the option of being able to retire later. And we're going to be talking a little bit about that over the coming weeks, and there will be a further webinar that I'm going to mention later, which will bring in the changes of the budget next week. But a figure of 400,000, which I believe is really a target mark for people to aim for, gives you the opportunity to basically earn around 6% a year from, which essentially gives you the equivalent of about 24,000 a year. Now that may seem to some people like a relatively small amount, but once you factor in the state pension, which is another 12, 13,000 a year, it brings you up to that threshold of not suffering tax at the higher rate. And if you have a situation where maybe there's another partner who is on a similar type arrangement, it typically, bearing in mind that you don't have dependents normally at that stage, and obviously any liabilities, it should be enough to carry you through for those years in a reasonable income lifestyle capacity. The next threshold of 800,000 is again what I call a sweet spot, where if you can build up a fund of that figure, revenue allow you to take a quarter of it tax-free, which is 200,000, and the balance of monies then would give you an income of about 36,000 a year. Now, sometimes people worry about what happens if you pass away early, or indeed if you pass away just after drawing it. And the key thing to understand is your pension does not pass with you. You know, it can be passed on to your estate, and it's very tax effective in that situation. The third figure that I put on here may seem like a very large figure to some people, but 2.15 million is the absolute maximum amount that anybody in Ireland can or should retire on. Now, some people who say are business owners who may have the capacity to pay much larger amounts, or perhaps have been working in service for many, many years, could get up to that sort of figure. Now, again, you know, that comes down to more of a conversation around tax planning and estate planning, because it's very hard to spend that amount of money in your retirement, I assure you. I just want to talk briefly there about a very simple scenario about why, as I said, pensions are a really effective vehicle to reduce tax. This is an example of Mark, who's a 30-year-old earning 50,000 a year, again, putting 15% of his salary into a pension fund. Again, whether it's him or his employer or a combination of, the illustration really stays the same. Now, the point being is that if he doesn't pay into a pension, his take-home pay would be about 37,000 a year. However, if he makes a decision that he wants to contribute to a pension, and if he pays that 15% on his own bat, which is a figure of 7,500 gross, revenue will give him back 3,000 euros of tax that he would have suffered, and hence his net cost is 4,500. Again, a very, very effective way of getting money back from revenue. This would achieve a pension fund of approximately 930,000 euros by the time that Mark hits 65, which is an income of around 36,000 a year. And obviously with the fact that he's entitled to the state benefit. And in addition to that, Mark is going to draw down his maximum tax-free cash amount. So it just shows that, you know, without too much pain, not only does a pension enable you to reduce tax, but it enables you to have a lifestyle that you would like to obviously have. Now, some of you may be wondering, well, okay, how are we going to afford this? You know, you're talking about contribution levels of, you know, 15% of salary. Again, for most people who have a situation where their employer is funding their pension, and from next year onwards, companies will be forced and mandated to do so, albeit at a low level to start with. I just want to show you a very quick slide. Now, it's a little bit fussy, but you can see here that how we work with clients is about helping them save money in order to enable them to fund their pension appropriately. This could be in helping them to achieve a lower mortgage rate, fixing at a lower rate, negotiating with their own bank. There's not necessarily a lot of drama in doing this, but we are saving clients on average about 120 euros a month. And the key question I'd always ask anybody is, are you paying interest of over 2.25%? Because if you are, I do believe that there's an opportunity for you to do something about it now. The same with mortgage protection. We come across a lot of clients who are oversold mortgage protection. They haven't necessarily shopped around. They may have bought it from the bank that sold it to them, who are tied agents. And I think personally it is absolutely, you know, crazy for people to be paying more than 25 euros a month, particularly, you know, if you're in a situation where you have a relatively moderate mortgage. Now, again, I caveat that by saying it depends on every person's situation, but typically speaking, that would be the most that people should be paying. House insurance, we broker that for clients. We generally find that we can find savings as we can with car and health insurance. One of the things you may spot there on the slide about pensions, many of you may have pension schemes from, say, previous employments, and I think it's really important to understand the costs of these. Some pension funds are very expensive, and what we do for clients is find out how much they're paying and making sure that they're not paying more than they should be. The same goes for loans and also savings plans. We talk to clients about getting their money working harder for them, and the key thing to note is that whilst there are some very good options out there with some of the insurance companies, the cost can vary hugely. I saw cases recently where clients were being charged 5% of every contribution that they were paying into the pension, to the savings, sorry. Typically, I'd say to them that they shouldn't be paying any amount of a contribution to start a savings plan or indeed exit. And that's something that we would talk to clients about. Just want to talk briefly there about if you're self-employed or if you're a POE worker, this is the time of year where people in the, I suppose, financial services industry, talk to them about making sure that you're aware of the fact that you can file a return before the end of, the 16th of November, and get a 40% rebate, not only on this year's tax, but also last year's. It's kind of a way of making a bit of a catch up. So again, if somebody hasn't fully utilized their pension contribution for last year, and say they're in a slightly better position perhaps this year, they're in a position where they can pay a one-off payment. And we're happy to help you and advise you whether you have a company scheme or whether you're just looking to see how that can benefit you. And this also applies to people who are in the public service. You can make what's called an additional voluntary contribution, or an AVC, not necessarily just to core market or any specific provider. You have the ability to do that through whoever you choose, but it's really important to make sure that you do get independent advice. Some of you are a business owner on this call, and as a fellow business owner myself, what I would say is that there's huge opportunity for you to use your company, whereby it's a great extraction vehicle to take money out of your business, and there's benefits both to the business and to you. So the example given here is that if you take 10,000 euros out of your company and put it into a pension fund, all of that money, i.e. 100% of it, goes straight to the pension, and there is no employer's PSI. However, if you take that as a bonus, not only does the company have to suffer an 11% extra cost, but you would lose typically 52% of that to revenue, which is obviously, over half, which is why we would say to business owners, it's really important to make sure that you are looking at your company and making sure that you're extracting money effectively. This is something that maybe some of you may not be aware of, but a lot of people perhaps who are looking to acquire property, not to live in, I should add, but as an investment, can use their pensions as a vehicle to do so. It's something that I have done myself for many clients, and it's something that I'd like to suggest that we can help you with if it's an area that you'd be interested in discussing with us, and I'm more than happy to give you some guidance and advice on that. I'd like to talk now briefly just in relation to the second option of reducing the tax you pay. And this is a really attractive scheme for high rate taxpayers. There's a qualification that you have to be a high rate taxpayer. It may or may not apply to yourself, but perhaps to your partner. And it is an individual scheme. So it's something that you can do, and indeed maybe your partner can also. And I'm going to stick to the example I used of, say, someone who's earning 50,000 a year. Typically, they would be paying tax at the higher rate of at least 10,000 euros of that. And the way this scheme works, and I can send you some more information, there's a revenue link if you want to Google it, on this scheme. It's called the Employment Investment Incentive Scheme, or EIIS. It has been available since 2011. It has become more popular since 2019. And certainly it's something that I would suggest anyone who has income at the higher rate, including rental income, which this qualifies for, which pensions don't, by the way, is that you can invest a sum of money, and it is a lump sum investment, a minimum of which is 5,000 euros, and basically benefit by getting a reclaim on tax that you pay this year, and also interest on top. Now, I'm going to keep the figures simple. So for someone who, say, is on 50,000 a year and has 10,000 euros that they can commit to this scheme for a 5-year period, it's the maximum period of which the scheme will go for. It could finish from any stage between 4 and 5 years, but I'm erring on 5 years to be conservative. If you were to put 10,000 euros into the scheme, you would get 4,000 euros back from revenue within the first few months of the following year. So typically for anyone who does it this year, by March next year, you'd get your 4,000 back from revenue. It's a very simple process to get the reclaim. We can do it for you. It can basically be done through the Ross system, or just by virtue of us sending a cert off on your behalf. In terms of what you get back then after the 5 years, you expect to get your investment of 10,000 euros back, but also profit of about 20% net of fees and tax. Now, I'm going to mention 2 companies in this space. There's over 60 companies a year that look to advertise. I'm actually going to meet the owners of this business, Blacks of Kinsale, tomorrow afternoon, obviously for anyone who is listening live. And it's a fantastic company. I have no bias in the company itself. I actually don't drink whiskey personally, but Blacks is a really interesting story. It was founded around the same time as Alpha Wealth, which is 2013, by a husband and wife duo, Sam and Maudlin. and the company has gone from strength to strength. It has a valuation of about 15 million. You can see the number of awards the company has won. Their turnover last year was 2.1 million. They grew during COVID. Their turnover this year is on target to be in excess of 3 million. And they're raising 5.4 million, of which they've raised most of that money already. There is still a limited opportunity for anyone who is interested in this scheme, where they're going to expand further globally and really push their product out and grow their market. They have a great distribution channel. They have clients in many different areas, including the likes of Musgraves, Centra, SuperValue, and so on. And it's just a really good success story. We're happy to give you some more details, as I say, and we provide this scheme directly to our clients and we manage it on your behalf. It's a very simple process for anyone who is interested, even in getting the detail. And what I would say to you is that if it does apply to you, get information. We can provide you details on the companies, the accounts, and as I said, we do it without bias. The other company I just wanted to talk about this evening is provided through an investment intermediary called BVP. They're based in Dublin, and they have provided a renewable energy fund over the last 8 years, since 2013. It's based on sustainable companies in the ESG space, which stands for social, environmentally governance. And it is a really attractive fund with a good track record. And again, we can give you some more details and explain a bit more to you about how this works. Typically, this scheme, they invest in 3 or 4 companies, so it does provide a little bit more diversification, and it's a slightly different area. And some people may like the idea of blending the investments between the 2 companies, the minimum for both of which is 10,000 for these particular schemes. It can be lower with other companies if anyone is interested in doing so. I just want to finally mention that we are providing discounted financial reviews. Basically, for anyone who's interested, we can offer you a full financial review where we can set out your financial goals. We can give you financial objectives and help you with areas such as clearing mortgages, planning for education needs for children, cash flow modeling, helping you understand and navigate the next 5, 10, 15, 20 plus years, and also identifying ways in which we can help you, whether they're of any benefit to Alpha Wealth or not. It's really about trying to make the most of your money and help you understand and save costs in various different areas, including things like health insurance, mortgages, and so on. And as I said, we are offering that for a limited time for €99 plus that. It works out to be a total of €121.77. A lot of financial advisors charge significantly more for this process. And as I said, it's a really simple thing we do over Zoom or in person. If anyone would like to book an appointment with us, please do feel free to do so. I see that somebody has asked a question in the chat. We will be addressing them very shortly. And I would encourage anyone else, if they would like to, please do feel free to populate the chat with any questions they have. Finally, I just want to mention, we are doing a follow-up webinar on Thursday, the 13th of October, again at 8 p.m. But please do listen out and reach out to us for other webinars we're doing. We are running a series of these over the next few weeks, broadly based around helping you reduce tax, helping you to get your savings working for you, working on areas that are coming out of the budget and so on. And as I say, the next one that I'm running on 13th of October is specifically focusing a little bit more detail around how we can help people save a minimum of 2,000 to 10,000 euros, implementing some of the ideas that I've mentioned already, but also talking about 1 or 2 others, as I said. So what I'd like to do now is just pass you on to my colleague, Cleena O'Donoghue, who's, as I said, going to be asking some questions, and obviously going to go through some of the questions that we've had over the last couple of weeks.
Okay, so we've one in the chat box there, Nick. It's, are dentists eligible to operate as a private limited company?
The answer to that question is yes. We have assisted some dentists in operating as a private company. It is an area that typically falls under accountants, and we've worked closely with several accountants throughout the country and given specific advice to the dentist about whether it's worthwhile for them to do so, and basically the pros and cons of doing that. So if you would be interested, again, please feel free to get in contact with me directly. You can email me, nick@alphawealth.ie, and I can give you a little bit more steerage in terms of how that can be done for you, and perhaps, again, just getting some information to see whether or not it's appropriate for you.
And the next question is, can you give an idea around the maximum amount of tax that can be saved per year?
There's huge scope for people to save money in tax. I gave you some illustrations there earlier about the limits of, what people can do. So for those people who are on higher earnings, let's say if you're earning, 100,000 euros plus, if you think about the scope of, someone in their 40s who can put 25% of their earnings into a pension and backdate a year, that's a figure of up to 50,000 euros. Now, again, that's only on the pension side, and then separately on the other tax scheme that I spoke about, which is the EAS scheme. Again, if you have the ability financially to do so, i.e. money in the bank, you have the scope to put, again, large amounts in based on the amount of tax that you pay at the high rate. So you can basically mitigate all of your tax at the high rate if you choose to do so. So the short answer to the question is, it depends on how much you earn, but the scope can be very large in some cases.
Now, this is another one just around, it's how do I get more into my pension if I'm in the HSE?
Through what I spoke about earlier, which is additional voluntary contributions. And if anyone is with the HSE or any public body, we're happy to give you some guidance and advice and give you a sense of what your pension is likely to be worth and how you can use AVCs to your advantage and make sure that you're in the right type of AVC and invested appropriately for yourself.
So why don't more people set up a holding company and buy rental properties that way instead of the harder way of a self-managed pension fund that can own the property?
The main answer to the question is, and thank you for the question, is that there's no tax to pay if it's within a pension fund. So for example, let's say you buy a property in a holding company for 300,000, you're going to suffer tax on the rental income in the company, typically at 25%. And then you've got the issue of how you're going to get the money out of the company at some point in the future. If it's done through your pension fund, which obviously you've benefited by getting tax relief of payments you've made into the pension, the rental income that comes to the property is tax-free into the pension. And also when that property is sold, hopefully for a gain, there is no tax to pay on the profits that they're made from the sale price.
So this next question is, I want to retire at 55. What is the best thing for me to do?
Maximize your pension. It depends, I suppose, on your age, how much you have in pension funds. And it's not that I'm obsessed with pensions, by the way. I appreciate some people may have other investments and assets outside of pensions. And I'm more than happy to give you some guidance and steerage on this about rental properties, for example. Is it a good idea? Is it a good idea to sell and so on? But the key to that question really is you've got to take advantage of tax vehicles. The biggest problem for most of us is we pay too much in tax, and the taxman will always look for their wedge of our money. So if you can look at opportunities that will reduce your liability to tax, it's going to help you get to that point of financial independence earlier. But the main thing really is to help you understand and navigate all of those years between now and when you reach 55. And that's where these tools come into play that we'll happily provide for you based on the financial review that we're providing.
Should I be investing my pension in a high risk or low risk fund?
The longer you invest for, the more risk you should accept. So for me at 48 years of age, who's looking to draw the benefits down at 65, that gives me 17 years. And by virtue of that, I should be taking a fairly large degree of risk. As I get closer to retirement age, obviously that risk reduces. So the answer to the question really is, how many years do you have? If you're saving for a mortgage and you have 3 years, you're going to take a low level of risk. But if you're saving for a pension and you have 20 years, you should be taking a larger level of risk. Risk typically runs on a scale of 1 to 7, 1 being cash, 7 being very high risk. And it's really about finding the right level. And again, this is where we'd like to think that we can help advise you and assist with that.
So in regards to kind of companies, do you think that most big pension companies are the same? Because this person has said, I'm with New Ireland and the returns are worse than many other big companies.
Not all company pension fund performance is the same. We use an independent analysis tool to show people where their pensions are versus the best in the market. I do favour Zurich. I've gone on record to say that I think that their fund managers have vastly outperformed. But again, it's about understanding, where you are within that life company. So some life companies have some very good funds, and some life companies have some very bad funds, the same ones. So the thing to do is just make sure that you're appropriately invested, and also look at the fees that you're paying, because it doesn't always necessarily come down to funds. Sometimes fund managers can vary in terms of their performance, but the one thing that's absolute is how much you're paying of a fee, because that is the one thing that you can absolutely control. But no, the answer to the question is absolutely, there's massive variation between companies.
So what if my annual income is 100K and I want to relocate to another country in 5 years? Is it worthwhile to maximize my pension or save any other way?
It's a really good question. I say to people, you should always maximize your pension, subject to your affordability. Obviously, you've got to make sure that you are balanced in other things that you want to achieve in life, of course. But don't delay or defer just because you're moving country, in that if you're taxed in Ireland, you need to fund appropriately in Ireland now. And if you move to another jurisdiction, like I have a UK pension scheme for when I worked in the UK, I haven't moved it to Ireland. It doesn't make sense for me to do so. But I built up a pot in that scheme over in the UK, and I'm also building up, obviously, a pension pot here in Ireland. And the key thing to understand is that when you do reach that age, it could be at 55, 60 or whenever, they will amalgamate and you draw down the benefits in whatever jurisdiction you end up in.
So also regarding pensions, big US companies expecting a further 26% drop in share prices. Is now a bad time to invest in higher risk funds?
It's really hard to say what's going to happen with the market. So respectfully, I don't think you could say definitively that we're expecting a further fall in share prices. And we have to be very mindful of negative press, obviously, that tries to sensationalize this. We've had a really challenging 11 months since the highs in November, but we had a really exceptional July this year in stock market performance, which is a little bit random between some of the falls that we've experienced. Markets tend to be forward looking, and they've priced in a lot of the bad news. And I absolutely believe this, that there is no way that any of us can predict what's going to happen in the next 6 to 12 to 24 to 48 months. What I can say definitively, though, is the key thing about investing is, and as I said this earlier, it is about the time that you have, and it's about staying in the market. The likes of the Warren Buffetts of this world say all the time, don't try and be a speculator, don't try and time the market. Get into the market and stay for as long as you can. And the biggest problem for most people is that they lose their nerve and they make rash decisions. Now is not the time to get concerned, and now is not the time to leave a strategy, particularly if you have 5, 10, 15 years to go. You need to have faith in the manager and make sure that you're broadly diversified, but that you haven't overexposed yourself. That's a key thing to understand.
So as a GP, we are told that we can only pay into ABCs alongside the GMS pension and are not able to pay into a private fund. Is this correct?
It depends on how your income is derived. Like some GPs have a private income source. So obviously you have a medical list and then you have your private book. So that's not necessarily true. Again, it does depend on the level of your earnings, but we have many GPs who are paying privately into pensions. So the answer to the question really is, it just depends on your own specific situation. But if you'd like to email me directly, I'll happily give you a proper response to that.
From this person, it just says, I'm going to work in the UK but live in Ireland. I worked in Ireland for more than 10 years. What can I do now to maximise my pension?
If you're working in the UK, I presume you're being taxed in the UK, and therefore you have the ability to make pension contributions into a UK pension fund. It doesn't really matter where you reside, as in where you live yourself. But the point of the question, I suppose, is, again, assess where you are now. Assess your opportunities in terms of, are you still being employed in Ireland, in the Republic? If you are, try and maximize your ability to do so. But if you're working in the UK, engage with a financial advisor like ourselves, and we can help you understand what your options are going to be. But the key thing is always make sure that you're making contributions, and you will be entitled to some form of an Irish state pension, but also depending on how many national insurance contributions you accumulate, a UK pension as well.
One more question. It's what is the most tax efficient way to give money to my children?
There's something called a small gift exemption where every individual in Ireland can give up to €3,000 a year to another individual. And the reason this works really well for parents is that if you're in a situation of a couple who have a child, if you think about it, you can give that child €6,000 a year, or up to 6,000 a year, I should say, tax-free. And if you do it over a period of 10, 15, 20 plus years, that's a lot of money. And especially if they have a partner, you can give their partner 6,000. If they have children, i.e. your grandchildren, you can give all of them 6,000 each. So typically that's a really powerful tool. It seems like a small thing, the 3,000, but if you use it over time, it's a great way to give your children money tax-free with no use of an accountant. There's no drama with it. And it's just a great way to reduce any tax that they may have to pay in the future.
I think that's it in terms of the questions. So if you want to wrap it up, Nick, I'd say that's the end of the questions.
Great. Well, thank you very